Welcome to Working with Budgets, Planning for Prosperity. The objectives of this section include the following. By the time you are done with this section, you will be able to define what a budget is and the benefits of preparing and using a budget. You will be able to practice a basic process of setting up a master budget. You will understand better how to use budgets to control your business activities, and lastly, help you identify principles to effectively apply budgets in enterprises. We move to session 1, budgets and the benefits of budgets. What is a budget? A budget is a financial plan set in advance for a period of time in the future. We can also define a budget as a plan to forecast the company's profitability and financials for a certain period of time in the future, like a month, a quarter, a year. It is an action plan for implementation illustrated in numbers. There are so many benefits that a business stands to gain when it puts proper budgets in place and use them. To summarize the benefits, we'll look at planning. It helps the company in goal orientation. The budget sets the tone of the goals that will be achieved in the financial year ahead. It helps every member of the team to aim at achieving the enterprise overall objective. It also informs the preparation of resources required to achieve these goals that have been identified and set, and anticipate risks that can occur in achieving this goal. Another major benefit of budget is controlling. A budget helps to benchmark for evaluation. How have we done well? It also helps in the delegation of authorities on expense approval and usage. A budget helps to create cost consciousness because there will be people responsible in the organization for controlling cost. It promotes teamwork as every member of the team is working towards achieving the organizational goal, and improves communication because every member of the team is on the same page and understand the goal to be achieved. How do we develop a master budget? A master budget is a budget that comprises of a projected profit and loss or income statement budget, projected cash flow, and also a projected balance sheet. A projected profit and loss, which is one of the components of a master budget, is basically in two parts: projected revenue and projected cost. The figures presented in this projected report refers to the sales budget and the budget of related costs. The projected profit and loss statement or projected income statement provides a basis for the evaluation of the enterprise's performance efficiency. These projections are useful for management to evaluate whether the objectives set have been achieved or not. Let's take a look at the sales budget. The sales budget comprises basically the sales volume budget at a projected volume and the projected selling price. The sales budget contains information specifying what sales volume we are targeting to achieve in the new financial year or quarter or month, and at what selling price. It can be for a quarter, it can be for a month. It's part of the projected profit and loss statement or projected income statement. The second part of the projected profit and loss statement is the expense budget. The expense budget emanates from the sales budget. After the sales budget is complete, the cost budget will be constructed in line with the sales budget. The cost budget varies depending on the business activities. Could be manufacturing, trading, or service providing, and management styles of the enterprise. A trading enterprise does not have a production budget, or a service business does not have either a production or stock budget. Let's take a look at selling expense and management expense budget. This budget is under the expense budget. The budget of selling and management expenses illustrates how much management projects to spend on selling and managing the organization. Budgets of selling expense and management expense are often constructed after the sales budget is established and based on the projected sales volume. The costs included in the budgets of selling expenses and management expenses are often divided into variable cost and fixed cost. The next budget we are going to take a look at is the production budget. The production budget forecasts the product output to be purchased to meet the sales volume projected in the sales budget and the budgeted stock requirements in line with the enterprise stock policy. As you can see, this production budget can be quarterly, monthly, half-yearly, or yearly. Advisable, we need to have a budget for the whole year ahead of the financial year. Another budget that would help us in our profit and loss statement is our raw material budget. In order to forecast the amount of raw material required to meet the production needs and stock requirements, the budget of raw material cost comprises of the main components like the quantity and the cost of raw material required for the production, the amount of raw material to be in stock, and raw material amount to be purchased. The amount of raw material required for production is calculated based on the amount of products that need to be manufactured as indicated in the production budget and the amount of raw material per product. The cost of raw material required for production equals the amount of raw material required for the production multiplied by the unit price of raw material required. Let's take a look at the direct labor budget. The direct labor budget. In order to forecast the labor required to meet the production needs, the budget of direct labor cost comprises of the two main components required to price labor. Number one, labor hours, and secondly, standard labor hour rate. The labor hours is calculated based on the amount of products to be manufactured as indicated in the production budget. The standard labor hour rate comprises of wage and allowances. Direct labor cost is thus the required labor hours multiplied by the labor hour rate. This takes us to overhead cost budget. You recall I defined overhead as the costs that cost across every department. Similar to the budget of selling expense and management expense, the overhead costs are divided into two categories: variable cost and fixed cost. Total variable overhead costs are estimated based on the rate of variable overhead cost. The rate of variable overhead cost can be estimated based on the total direct labor hours, total machine operating hours, or based on the operations. While total fixed overhead costs can be estimated based on historical data. After gathering the total cost amount, the non-cash overhead cost will also be separated to determine the cash overhead costs. This will take us to the budget of cost of goods sold. A manufacturing enterprise would budget cost of goods sold in two major categories: production cost and stock budget. Production cost includes direct raw material cost, direct labor cost, and overhead cost. These figures are taken from the budget of direct raw material cost, direct labor cost, and overhead cost. While stock budget includes finished goods budget and work in progress budgets. All the respective budgets we've just discussed, like the budget of sales, budget of cost of goods sold, budget of selling expense, budget of management expense, make up the projected profit and loss budget. Another major component of the master budget is the projected cash flow. The projected cash flow helps to manage the movement of cash in the organization, and it's made up of two parts: cash inflow and cash outflow. The projected statement of cash flow are useful information for the enterprise management to foresee the periods that the enterprise would need cash to pay for its activities in order to make adequate provision for this cash. Section 3. Using budgets. Under using budgets, we will look at using flexible budgets, analyzing variances, and lastly, taking actions. A flexible budget is a budget that is set up corresponding to certain levels of changes in the volume of activities. A flexible budget is a budget that allows the projection of costs corresponding to the various certain levels of activity volume, often the production volume or sales revenue. Setting up a flexible budget. An illustrating example of setting up a flexible budget with different costs corresponding to the various production volumes ranging from 5,000 to 11,000 products. Variable costs remaining constant per unit. In order to arrive at the total variable cost, we multiply the variable cost per unit by the number of units at different activity levels, while the total fixed cost remained unchanged in the range of 5 to 11 products. By developing a flexible budget, you are comparing likes with likes. It is necessary to emphasize that the budget drawn up by a static budget envisages the cost corresponding to only one level of sales or production. When the sales or production volume varies, the cost will also vary. A static budget does not enable the enterprise to compare its performance based on the current level. As a result, the static budget does not provide a relatively accurate benchmark that can be used as an objective assessment basis, especially when the actual results are remarkably higher than the projection. For example, comparing a static budget at a volume of 7,000 products with the actual result of a volume of 8,000 products is not different from comparing a piece of orange with an apple. The comparison leads to incorrect conclusion on cost variances. To have a consistent comparison when comparing actual figures with the flexible budget, we need to convert a static budget at a level of 7,000 products into a flexible budget at a volume of 8,000 products, and then compare this with the actual result at the same volume of 8,000 products. This comparison provides meaningful information on cost variances. Variance analysis. Variance analysis is the difference between your actual performance and your budget. We have favorable variance or adverse variance. When your actual performance is better than your budget, it's favorable. Let's take a look at some examples. When actual sales revenue is higher than budgeted sales revenue, that variance is favorable. Also, when actual costs are lower than budgeted costs, the variance is favorable. Unlike when actual sales revenue is lower than budgeted sales revenue, that is an adverse variance. Or when actual costs are higher than budgeted cost, that is also an adverse variance. So we see that the variance analysis for a profit that is declared at the end of the year is made up of revenue variance and cost variance. And cost variance is made up of raw material variance and labor variance. It is necessary to determine whether the variances are caused by the sales or the expenses when analyzing profit variance. Lastly, we must take action on these variances we've identified. The next step after identifying variance is to identify what is responsible for the variance or variances. In order to identify what is responsible, we can look at the variance or variances from two different perspectives. Was the budget unrealistic? Then we have to adjust the budget. Or were our operations below standard? Then we need to improve our operations. After doing the variance analysis, managers should carry out the assessment as below. For out-of-control variances, managers should analyze errors of inaccurate projection and make more appropriate adjustments to the budget. For under-control variances, managers should narrow down the responsibility of the departments in charge of implementation and controlling the budget. Their responsibilities are to seek appropriate solutions to improve the operations. Kindly take the course activity that follows for better understanding. Thank you.